All right, what's up everybody? My name is Faris Salim. I'm the CEO of Salim Stock Picks. Today I'm going to talk to you about Fibonacci retracements and how you can incorporate it into your day trading, swing trading, long-term investing, whatever, in order to become a better trader and have better entry and exit points. Okay, so I'll give you some background on Fibs, but first I want to give you some background about myself. I do run a day trading and swing trading chat room in which we base all of our trades off of technical indicators. So if you want to learn about any more or really just want to improve your trading, you can sign up for a free week. Just click the link below. All right, but right now we're going to jump into the background for Fibs and how you can use them to your advantage. All right, so Fibs were initially created by, and Fibs short for Fibonacci, of course. Fibs were initially created by Leonardo Bonacci, an old Italian mathematician. And this was way back when essentially this guy figured out that this sequence can be applied to many different things in nature and of course within our charts. And it's crazy that it still works to this day so well. But when I say nature, I literally mean nature, right? He figured out that, the ways trees branch out, the way stems, leaves actually form and assemble on the stems has this same mathematic principle applied to it. Okay, so essentially the basics of this sequence up here, and you can see that this is an endless sequence, but I just listed some of the main numbers here, the starting numbers, 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89. The way this sequence works is that the sum of the two prior numbers equals this one. Okay, so 0 plus 1 is 1. All right, 1 plus 1 is 2. 2 plus 1 is 3. I know this is really hard mathematics, but bear with me, guys. And then on top of that, in order to get the levels that we're actually going to use, the ratios, the percentages that are actually used in the Fibonacci retracements, you divide each number by the previous number and you get what we call the golden mean, right? Phi, 1.618. And not every single one is going to come out to exactly 1.618. It's usually, 1.612, 1.613, 1.62 even, whatever. But for the most part, it all revolves around 1.618. Now, this is the ratio that can be applied to a lot of different trading methods. This sequence is very commonly found in the majority of, a technical trader's, chart analysis, right? So a lot of people apply these to moving averages, whether it's exponential or simple or displaced. A lot of people apply this to their technical indicators, pretty much just the inputs in general, right? So these aren't necessarily the numbers that we use with Fibonacci retracements. The numbers are calculated by dividing each one of these numbers by 2 numbers later, 3 numbers later. So for example, 8 divided by 2 numbers later is going to give you the number 0.382, right? 38.2%. And that is one of the levels that you'll see in the Fibonacci retracement. Now, 8 divided by 3 numbers higher is going to give you 0.236. Okay, and so on and so forth. And that gives you the numbers that we use in our charting method. Okay, so let's draw up some of these fibs, and we're going to use Tesla. TSLA is the ticker as an example today, and I'll show you exactly how you can use these in your trading. But one quick thing that I want you to know is that I do not recommend that you guys solely base your trades off of fibs. I think it's great to analyze inflection points, and if you don't know what inflection points are, pretty much just a point on a chart, a level that is going to act as support or resistance and potentially even reverse the stock, right? So you have to have other components of your technical analysis. So inflection points are crucial, but you also need some kind of short-term technical indication, and that can come from whatever technical indicators you like to use that gives you your entry and exit. Okay, and then on top of that, you have to be able to depict the trend and actually decide which way the stock is going. Now, it sounds easier than it actually is, but it's safe to say, a long-term trend, a short-term trend, whatever, is fairly easy to read just based on the direction. Right. On top of that, if you apply the text to it, then you get good ins and outs. But it's hard to actually establish targets and see where a stock is going to get, rejected or bounce before continuing in the direction that you're going with. Okay, so just to show you a quick visual representation of what you need to look for these 3 components. Right, you have the trend established on the stock. Right, this is a basic trend channel. Stock is bouncing like this. And you can use the fibs as an inflection point in order to see where it's going to pull back to prior to continuing higher, right? There's the inflection point that may act as support, or even just reverse the stock the first time around when it touches it, right here. But then you need the technical indicators that are going to say, all right, buy the stock. Right now it's going to actually move to the next level and break out over resistance. Okay, and of course you need to be able to analyze that trend. So those are the three components that you need to focus on, but right now we are zoning in on inflection points, Fibonacci retracements. All right, so let's draw this up. Let me erase all this nonsense. And I primarily use this on the daily chart. A lot of people like to use this on the daily, weekly. Really, it's whatever works for you. And you'll find that that's the recurring theme throughout this webinar, that, you know, it's obviously what works for you, but what, you know, fits in with your trading style. Okay, if you trade based off of simple moving averages and exponential moving averages and, you know, trend line resistance on, you know, the 15-minute time frame, then apply these to the 15-minute. But, you know, I gotta say it's the same thing with any other support and resistance level. The further out you go, whether it's the daily or weekly chart, the better it is, right? The more formidable that inflection point is. It's a simple fact. Okay, if you have a stock that that gets rejected at a key level intraday, it's probably not as big of a deal as you know, it gets rejected at that level on the daily chart, right? Simple fact. So moving forward, let's actually draw up these retracements and I'll show you exactly how they work. All right. Now, keep in mind, before you draw them, you have to have a read on the chart. So it's safe to say that for this time period right here, Tesla was bullish, right? If you want to argue otherwise, then you're probably insane, okay? But it was bullish. That being said, since it is in a bullish trend, we are going to draw the fibs from low to high, okay? Because what we're looking for is a support level to either add more to our position or re-enter after we have exited. Okay, so either sizing in or just entering the stock for the first time around, second time around, whatever. Okay, so pretty much just looking for a continuation. All right, now, the way these levels work is that you need confirmation, but let's draw them up beforehand. And of course, this is just vice versa for the bear side, right? You're drawing from high to low. And what I mean is that we're gonna draw from this low to this high, and it's going to give us a bunch of key levels to watch for a bounce, right, in order to get that continuation where we go to the new high. Okay, so let's draw them up. All right, so you go to drawings if you're using Thinkorswim. If you're using another platform, then it should be fairly easy to find Fibonacci retracements. They're very popular, so I'd be shocked if they didn't have it. All right, fibs. Then you click on the low first, because we're going with the bull trend, then to the high. All right, and a lot of people, I find, you know, and I don't really have the hands of a surgeon either, but a lot of people find that it's hard to actually get it right to the high or right to the low. So afterwards, just double click it and then enter in the numbers. So here we have 141.05, and then the high was 269.34. And again, we are on the daily chart, all right, the 1 day, 1 year chart. Okay, I keep my levels in white just because I have the black background. It's easier to see. And as you can see, we have these ratios, these percentages that we calculated by using the Fibonacci sequence. Now that you know the math that goes behind it, I can actually show you, you know, how exactly we would catch a bounce on this stock. And one thing that you have to note is that the key levels here, the most commonly used levels, are the 38.2, 50, and 61.8. And remember, 61.8, 1.618, that is the golden ratio right there. Okay, so 61.8% is the key level where you're looking at for a reversal. All right, a lot of people also use the basic 50% rule, right? If a stock has retraced 50% from its recent highs, then it's probably switching over to a bear trend. Okay, that's an assumption, and you'll need other indicators to tell you that. But for now, we're going to focus on this. Okay, so those are the most popular ones. And how you would analyze this chart is essentially saying that if we pull back below this level and then reclaim it, we are likely to retest this level. Okay, so let me say that again. If we pull back below the next support level, according to the fibs, all right, and then we reclaim that level, it doesn't have to be immediately, just in general, right? We pop back above it, then we are likely to go to the next one. Okay, so let's look at this chart. So right here, we're testing this. Did it reclaim? No, it did not. We drop it down below this level. Did it reclaim? Yes, it did, right here. And did it hold the 50%? Yes. All right, you can't play the game where it drops way, way down below and then pops back up and you play it with the same logic. It has to reclaim that without dropping below the next level. Okay, so holds the 50% line, reclaim. That means the chances of us hitting the 23.6% level, and you have the prices marked over here on the right-hand side for you. At least Thinkorswim does that. I know the majority of platforms do it as well. But those are the price levels that you need to be watching. And this is great for options traders too, right? Because a lot of times people are saying, Tesla, way too expensive for me. I don't want to play it, right? I don't have the size to get a good buck out of it. But options traders can, look at the monthly call options. As it holds that and pulls away, you get that buy signal from your technical indicators, and then, clears that level. And as soon as you clear that, you buy the calls or sell the puts, and then cash it in as soon as it pops up above that level. All right, so Tesla, as you can see so far, pulled back, no confirmation that we're going to the next level yet. Boom, there's the confirmation right here, and we go to the next level. All right, so far we're 1 for 1. All right, now we drop lower, sinking much, much lower. Did we reclaim that level? Yes. Now we're going to the next one. So far, 2 for 2. Okay. And now it's safe to say that Tesla has formed, we're putting in lower highs. Tesla has now turned into a bearish trend, right? It is now a bearish stock. So what you can do now, and I'll show you the other side of things, and now that we've already nailed 2 profitable trades off this, is that we can, erase this and then delete our fibs. And since we were looking at a bullish trend and drawing from low to high, now we're going to look for a bearish trend on the short side and draw from high to low. Okay, so now that we have decided, all right, the trend has shifted, we've put in multiple lower highs, our trend indicators, the moving averages, whatever, are telling us that this stock is done. And you can use the 50% rule, the 61.8% rule, whatever. Now you take the retracements and you're drawing from high to low. And again, we're doing this not hindsight, we're doing this live, right? We're doing this live. So if I were to zoom in here, all right, we've already seen that there have been 2 profitable trades here that have signaled a continuation to a certain point. And these are 20-point plays. These aren't tiny price, these aren't tiny price swings. All right, so now we're drawing from high to low. All right, and I believe this low is 187.87, and we have the same exact high. So 269.34, just missed that one by a penny, and 187.87. That one's easy to remember. All right, so now we have the retracement levels for a move to the downside, right? We're essentially saying that these are going to be resistance levels that we should enter in on the short side. All right, so the same exact mentality as we had before, and let's zoom out again so we can look at this chart, right? We drew it here after we have decided that this is definitely in a bearish trend at the moment. And now we're saying that if we pop up above the level and then reclaim it to the downside, then we are going lower. All right, so we popped above 23.6. Did we fall back below it before surpassing the next level? Nope. So we go to the next one. We pop above 38.2%. Did we surpass it to the downside before going up to the next level? No. So we go to the next one. We got above it, dipped below it, and actually went straight down to the fib. So we're already 1 for 1 there, right? We perfectly bounced off that fib again. All right, and then went back up to that level. But notice we didn't go under it. So if we had gone under it, actually, let me erase that real quick. If we had gone under it, then that would have signaled a move here. But notice that it acts as, a crucial support level that you could have played a bounce play on the long side. But again, we don't want to go against the trend here. So let's keep reevaluating this. All right, so we pop above that level. Still haven't had a scenario where we drop below one under it, below a level under that. So we pop above, drop below, and now we have signaled a move to this level here, right? We popped above it, then dropped below it. So at 228.61, you have now said, all right, we are going down to 218.99. That's a 10-point play right there. That's a big deal. So again, you can play with puts, shares, whatever. Okay, so now we have gotten 1 for 1 there, and we are signaling a move lower because we have surpassed that level. now we are going down to here. All right, so that is down to 207. And if we pop above it, reclaim it on the short side, there we go, down to 187. And we just nailed 1 out of 1, 2 out of 2, 3 out of 3. So 2 out of 2, and now 3 out of 3 plays. That's 100% consistency just using the basic of the fibs. That's not even analyzing the trend in any other way. That's not even, using the technical indicators that you use that are, proprietary or work for you, right? And then at that point, you can apply other technical analysis, whether it's breaking out of this downward trend line right here to realize that, hey, we might actually get a reversal to the upside. Let's start trading it. And I'll tell you for sure right now, myself and other traders in my chat room, we use the fibs as this was a trend shift for us as we broke out of that downtrend line. We use the fibs to nail a move to 220, right? So it ripped to 220 and now is settling back down a little bit, but we cashed in right when we got over 220, and a lot of us played calls, a few of us played shares, and it worked out very well. All right, so again, the fibs are used as inflection points, and the key thing isn't just to break above it or fall below it. The best plays are when we pop above it and go back below to signal a move lower. Okay, those are the easiest plays. So let's actually review this a little bit. And again, we just nailed 100% consistency just with that. So the Fibonacci numbers in general can be used in a variety of ways, but primarily we're going to use it for inflection points where a stock can reverse. And on top of that, where it's going to catch support and resistance so that you can nail your entries and exits, right? And on top of that, you're really just looking for a continuation in the direction that you have established. So I always say to my members, it's really important to establish a bias beforehand. And sometimes, you can marry that bias and emotions can weigh in and it can really screw you over. But for the most part, if you have logic behind it, right? If you're playing a setup where you're breaking out over resistance, right? And you say, all right, I have a short bias until we break out over this resistance. I'm looking for a rejection. As soon as it breaks out, your bias flips, right? Or you go neutral. So as long as you have some logic behind it, it doesn't really matter. All right, but the important thing is here, understanding that, deciding that a trend is bullish or bearish, and then actually applying your technical indicators to it, and then using these inflection points can be very profitable. All right, so the fib numbers, as you saw before, are fairly simple. The math behind it is very simple, and those are the actual ratios that we use with these retracements. So again, when you are drawing for a bullish trend, you draw from the lows, to the highs. All right, when you are drawing for a bearish trend, you draw from the highs to the lows. All right, you can use this on many time frames. I primarily use it on the daily and the weekly. This doesn't just apply to equities. This also applies to commodities and futures in general. Okay, so something that I find very beneficial. All right, and let me just show you actually how you can apply a basic technical indicator, right? Let's use a really popular one. What's a popular one? Let's say the MACD, the Mac Daddy is what I like to call it. Moving average convergence divergence. All right, so basic technical indicator, you guys know how this works. Inputs are 12, 26, 9, and it's fairly simple, right? When the lines cross, you got a buy signal. When they cross back and below the zero line, whatever, you get a trend shift. But the basics of the MACD are telling you that, when we actually cross over, the trend has shifted. All right, so let's look at the MACD here, and let's mark some of the buy and sell signals. Okay, so this was the first green to red move from the MACD. Let's change this real quick and make this a little bit thicker. All right, next one. The next buy signal was right here. So let's make that green. All right, and let's mark this sell signal. And we'll make that red. Okay, and this is just the time at which it gave a sell signal, time at which it gave a buy signal, sell signal. Okay, so you're trading Tesla on the way up, and you have now drawn your fibs and you're saying, all right, where am I actually going to nail this entry? And the MACD is a very common technical indicator, all right? When those histogram bars switch colors and flip to the other side, go over the 0 line here, and when the lines cross, you get a buy or a sell signal. Okay, just a brief background for those of you that don't know about it. All right, so we drew it from the lows to the highs, and again, we have to double click it to get our key levels here, make them exact. All right, and now we're saying, okay, we want to go long on this stock, but we don't know where. So since we have now fallen below this level, we need to reclaim it in order to move into the next leg. Okay, so we fell below the level. Did we reclaim it? No. All right, so we go to the next one. Did we reclaim it? Yes, we did right here. And we got a buy signal from the MACD. So using that, you could have forecasted that it would have held, right? It would have broken and held. You go long, all right? You get a sell signal much later on, but for the most part, you hit your target, right? By the time you hit your target, you still had not gotten a sell signal. The MACD lines did not cross. And that is a very basic technical indicator. And I got to tell you, I didn't look at the Tesla fibs beforehand. I didn't do all this math. I looked at it way back when, but this can be applied to any chart, right? I didn't pull this up right before the webinar and go through it and rehearse or anything. I just pulled it up, boom, it worked. Okay, so these fibs can be very profitable if you just couple them with a basic technical indicator that'll give you your ins and your outs. Okay, so right there, just one profitable trade. I'm not going to walk you through the entire thing because that would take forever, but you saw exactly how the inflection points work, how we need to reclaim the level to move back up. Okay, and again, you're looking for a continuation in the direction that you have established on the trend beforehand. All right, so you don't want to go against that whatsoever. A good way to indicate a trend shift if you don't know how to use the daily moving averages is just having a rule saying, all right, if we've dropped 50% or 61.8% from this run up, then we're probably reversing. All right, so if you guys got any questions, throw them in the comments section below or reach out to me at slimstockanalysis@gmail.com. But I have a day trading and swing trading chat room. We have a free week trial. If you want to learn more about these, you don't have to pay me. I'd be happy to help you. I love helping traders. All right, so if you guys want to learn more about this, just let me know. Shoot me an email, drop it in the comments, whatever. But for the most part, I hope you learned something, and I hope you incorporate fib retracements into your trading. All right, thank you so much, guys, and have a great day.